If silver suddenly jumps near $87, the real story may not be the price at all. The real story could be what is quietly disappearing behind the scenes while most investors are still watching stock charts. Right now, many traders think this is just another metals rally like before, but what if this time the problem is not demand? It is actual physical supply running dangerously thin. Imagine waking up Monday morning and realizing the metal everyone assumed was abundant is suddenly hard to source. That moment is when markets stop being theoretical and start becoming emotional. Because once supply stress becomes visible, prices don't rise slowly anymore. They move fast, chaotic, and often before retail investors even understand what triggered the shift. If you care about protecting your savings from inflation shocks and market instability, this conversation matters more than ever today. And if you want calm, simple breakdowns of what is really happening in metals markets, subscribe now to Bullion Alert HQ so you never miss the next warning signal. Silver is not just a precious metal sitting in coins and bars. It is deeply tied into solar panels, electric vehicles, medical tech, defense electronics, and thousands of industrial components Americans use daily. That means when supply tightens, the impact spreads far beyond investors. It quietly touches manufacturing costs, energy infrastructure, and even national supply chains. During most years, mining output and recycled silver roughly balance global consumption. But recently, industrial usage has been rising faster than new supply can comfortably replace. This kind of imbalance does not explode overnight. Instead, it builds silently for years, until one moment suddenly exposes the weakness. Large institutional buyers often notice these imbalances early. They begin securing long-term contracts and physical deliveries long before headlines ever mention shortages. Retail investors usually hear about the crisis only after prices already surge. By then, premiums rise, inventories shrink, and availability becomes unpredictable. Some analysts are watching warehouse data linked to futures exchanges like CME Group very closely right now. These storage reports can sometimes reveal stress signals before price charts fully react. When registered inventories start falling while demand rises, it creates a dangerous setup. That setup means more paper contracts may exist than immediately deliverable physical metal. Most of the time, the system works smoothly because not everyone demands delivery simultaneously. But markets depend heavily on confidence staying intact. If confidence breaks, traders suddenly prefer real metal instead of paper exposure. That shift alone can rapidly drain available vault supplies. And once vault withdrawals accelerate, the psychology of the market changes instantly. Investors stop asking, "Oh, should I buy later?" and start asking, "Will it still be available later?" This psychological flip is what historically drives the sharpest commodity rallies. Fear of missing access often becomes stronger than fear of paying a higher price. In previous financial stress periods, precious metals reacted not just to inflation, but also to trust concerns. When investors doubt stability, tangible assets suddenly feel much safer. Right now, the macro environment contains several pressure points building at once. Inflation, uncertainty, global trade tensions, energy price swings, and geopolitical instability all amplify safe haven demand. When multiple stress signals align together, metals markets tend to react faster than traditional equities. They become early indicators of deeper financial anxiety. Another factor many casual viewers overlook is how small the silver market actually is compared to stocks or bonds. Even a modest institutional allocation shift can move prices dramatically. If large pension funds or hedge funds increase physical exposure slightly, the available float tightens quickly. That makes price spikes more violent than most models predict. Meanwhile, industrial users cannot simply wait for cheaper prices. Factories require continuous metal supply to keep production lines running. This forces manufacturers to secure inventory, regardless of short-term price swings. That steady buying pressure quietly strengthens the floor under the market. At the same time, mining companies cannot instantly increase output. Opening new mines takes years, environmental approvals, financing, and infrastructure planning. So, when demand surges faster than production growth, shortages cannot be solved quickly. Markets must instead rebalance through higher prices. Some investors compare this setup to previous commodity supercycle beginnings. Those periods often looked calm right before entering their strongest acceleration phase. What makes the current situation especially sensitive is the broader financial backdrop in the United States. Interest rate expectations, debt levels, and economic slowdown fears all influence safe haven flows. When recession concerns rise, while inflation remains sticky, investors face a difficult dilemma. Traditional portfolios struggle because both bonds and equities can feel unstable at the same time. That environment historically pushes attention toward hard assets. Silver often benefits disproportionately because it combines industrial demand with monetary appeal. Gold tends to move first during fear cycles, but silver often moves faster later once investor participation widens. That is why some experienced traders watch the gold-silver ratio closely. When silver begins outperforming strongly, it can signal growing supply tension underneath the surface. Recently, many private dealers across North America reported increased retail interest. While not panic buying, the steady rise in physical orders suggests growing awareness. Retail sentiment rarely drives markets alone, but combined with institutional accumulation, it can accelerate shortages faster than expected. Another subtle signal appears in delivery wait times. When fulfillment periods slowly extend from days into weeks, it often indicates logistical strain building behind the scenes. These delays rarely make mainstream financial headlines immediately, but experienced metals investors treat them as early warning indicators. Even central bank policy indirectly affects silver dynamics. Decisions from the Federal Reserve influence currency strength, liquidity, and real interest rates. When real yields fall or uncertainty rises, non-yielding assets like metals suddenly become more attractive. That capital rotation can happen surprisingly quickly. Right now, many investors feel the global system is entering a more fragile phase. Debt levels remain high, while economic growth projections stay uncertain. In fragile environments, markets often move not on confirmed disasters, but on the fear of potential disruption. Expectations alone can trigger supply hoarding behavior. Once hoarding begins at industrial or institutional scale, the available tradable supply shrinks rapidly. That contraction alone can push prices higher even without new demand growth. This is why the move toward $87 may matter far more than it first appears. It could represent not just a rally, but a stress signal. And if that signal reflects deeper structural shortages, the next phase may not be slow at all. It could become one of those rare market windows where prices reprice extremely fast. Because the real question is not whether silver touched 87. The real question is what happens if physical availability tightens further while global anxiety keeps rising. And that is exactly where the story becomes much more serious. If physical silver keeps tightening while prices hover near the high 80s, the next stage is usually not stability. The next stage is volatility that feels sudden and confusing to everyday investors. At first, financial media may describe it as normal commodity movement, but behind the scenes, procurement teams and institutional buyers start acting with much greater urgency. When large buyers begin securing multi-month inventory buffers, available exchange supply can shrink faster than public data suggests. That hidden tightening is what sometimes turns a strong rally into a supply panic. Markets rarely announce the moment stress becomes critical. Instead, small warning signs appear one by one until suddenly everyone notices at the same time. One dealer reports longer delivery delays, another reports higher wholesale premiums. A refinery quietly prioritizes industrial clients over retail orders. A logistics firm reports unusual outbound vault shipments. None of these headlines alone look dramatic. But together, they form the early pattern experienced investors watch very closely, because once real availability becomes uncertain, price discovery stops being calm. Buyers stop negotiating and start securing whatever supply they can confirm. That behavioral shift is what transforms a rally into a squeeze environment. And squeezes move far faster than traditional bull markets. Many new investors assume price spikes happen because of speculation. But historically, the sharpest commodity surges happen when physical supply confidence breaks. Confidence is the invisible foundation of futures markets. As long as participants believe delivery is always possible, the system runs smoothly. But the moment traders begin doubting easy delivery access, contract behavior changes immediately. More participants request physical settlement instead of rolling forward. That alone can accelerate vault withdrawals dramatically, and shrinking inventories often trigger even more delivery requests. This feedback loop is why shortages sometimes look calm until suddenly they look explosive. It is not one event, but the chain reaction that follows. Industrial demand adds another layer of pressure that investors sometimes underestimate. Unlike speculative traders, manufacturers cannot pause production just because prices rise. Solar panel factories still need silver paste. Electronics manufacturers still need conductive components. Medical equipment suppliers still require precision silver contacts. Defense contractors still require specialized alloys. When industrial buyers compete with investors for the same tightening pool, markets become extremely sensitive. Even small additional demand can push prices disproportionately higher. This is where many American investors start asking the most important question. Not will silver rise, but how fast could it move if supply truly locks? Because historically, once shortages become obvious, price adjustments often compress into very short time windows. Moves expected over years sometimes occur within months. During those periods, headlines usually arrive after the majority of the price move already happened. Early positioning always matters more than late reaction. That does not mean panic buying is wise. It means awareness and preparation matter before markets become emotional. Smart investors focus on understanding structural trends rather than chasing sudden spikes. Structural supply deficits tend to last longer than emotional rallies. Right now, several structural forces are aligning simultaneously. Industrial electrification demand continues expanding while new mining projects remain slow. Recycling supply growth has limits. Ore grades at some major mines have gradually declined over time. Energy transition policies continue encouraging silver-intensive technologies. Meanwhile, geopolitical uncertainty keeps safe haven demand alive. When multiple long-term demand drivers meet constrained supply growth, markets often enter multi-year revaluation cycles. These cycles rarely move in straight lines, but their overall direction can remain strong. This is why experienced analysts often focus less on daily price moves. They watch inventory trends, industrial contracts, and delivery behavior instead, because those deeper signals reveal whether a rally is temporary excitement or structural repricing. And structural repricing is what changes long-term investment landscapes. For viewers here on Bullion Alert HQ, the goal is never fear. The goal is clarity before mainstream coverage catches up. Understanding how supply chains behave during tightening phases gives investors a massive informational advantage. Calm preparation almost always beats emotional reaction. If silver stabilizes and supply normalizes, markets may cool naturally. But if inventories continue shrinking while demand holds strong, volatility could remain elevated much longer. And the longer tight supply persists, the more sensitive price becomes to even minor disruptions. A single unexpected mining interruption or shipping bottleneck can suddenly matter far more. This is why professionals constantly monitor global transport routes and refining capacity. Commodity markets depend as much on logistics as they do on geology. Even currency fluctuations influence metal flows. A weaker dollar environment can sometimes amplify global investor interest in hard assets. Meanwhile, domestic economic anxiety inside the United States can quietly increase retail participation. When households feel long-term purchasing power pressure, tangible stores of value gain psychological appeal. This effect builds slowly and then accelerates once social awareness spreads. Financial trends often behave like dominoes rather than switches. One investor tells two friends. Those friends begin researching. A financial podcast mentions tightening supply. Then mainstream coverage finally notices the trend. By that stage, early accumulation phases are usually already finished. Late participants often face higher premiums and thinner availability. That is why staying informed early matters far more than predicting exact price numbers. Timing awareness beats price guessing almost every time. If you've watched this far, you already understand more about the silver market than most casual investors scrolling headlines. And this is exactly why staying connected to reliable analysis matters. If this breakdown helped you see the bigger picture, drop a comment below telling me whether you think supply tightness will ease or intensify this year. Your perspective actually helps shape what we investigate next here on Bullion Alert HQ. And if you know someone worried about inflation, market volatility, or protecting long-term savings, share this video with them now. One share could genuinely help someone avoid making a rushed financial decision later. Markets reward preparation, patience, and awareness far more than hype. The investors who usually win are the ones who understand structural shifts before they become obvious. Because the real silver story is rarely the daily price. The real story is always the supply situation quietly developing underneath. And if that underlying pressure keeps building, the next major move may not wait for anyone to feel ready. So stay alert, stay informed, and I'll see you in the next update.